Hi, Carolyn Larsen-Wieber here, CLW Financial Planning. Today's video is, drumroll please, tax planning, making your money last longer in retirement. Yep, I said that right. If you do proper tax planning, you can make your money in retirement last longer. And I've done that with lots of my clients. And it's my ultimate favorite subject because when I find some good tax planning strategies, I'm like in heaven, and my clients of course are absolutely in heaven, because you know why? The more tax I save, the longer their money is going to last. So the first thing that we all have to understand is when you're going into retirement, you're actually going to be doing the opposite of when you were working. When you were working, you were accumulating and you were putting money in. When you're in retirement, you're doing the opposite. You're like pulling money out. And so you're probably going to have all these different types of accounts, and it's important to know the tax characteristics of those accounts. So if you have a 401k, if you have a pension, if you have annuity, if you have Social Security, if you have plain old interest from CDs, all of that is taxed at ordinary income, okay? In 2020, the ordinary income tax rate, the top rate, I'm talking about the top rate, is 37%. Now let's compare that to other types of accounts that you can withdraw from. If you withdraw accounts from your, if you withdraw money from your taxable accounts, you could be drawing money that have been qualified dividends or long-term capital gains or long-term capital gain distributions. Those types of income are taxed at a preferential rate. What is that preferential rate? It's either 15%, 20%, or in some cases, 0%. Yep, that's right, I said it, 0%. Who wants to pay 0% on selling their IBM or their Bank of America or whatever stock? So with proper tax planning, you actually can pay 0% on capital gains. So that's the importance of understanding the different types of accounts that you have. In addition to understanding that, if you happen to be in the accumulation, if you happen to view this and you're in the accumulation stage, do you hear my birds? Then it's important for you to think about planning now for retirement, so that when you're building your accounts, you make sure that you're just not doing everything plowed into your 401k. You want to be putting money into your 401k, you want to be putting money into a taxable account, and one of my favorite accounts is a Roth account. A Roth account is you put money in and you pay the tax today. Once you put it in, it grows tax-free forever for your lifetime and for the lifetime of your heirs. Now I want to turn your attention to conventional wisdom in financial planning. Generally, you read a lot about withdrawal strategies, and typically the conventional wisdom in withdrawal strategies is as follows. When you first go into retirement, you take everything from cash, then you take from your taxable account, you drain that. After you drain that, then you go to your tax deferred accounts, which are your 401ks, and after that you do your Roths. That's the conventional wisdom, and many times that's the default in our tax financial planning software. However, that might not be the best strategy for the reduced taxes that you could be paying. And so that's why when we do financial planning, you definitely want to talk to your CPA and your financial planner. Get them in the same room and have them run long range planning. Scenario 1, conventional wisdom. Scenario 2, some kind of a hybrid. Scenario 3, and see what is the best plan for you and your particular situation. Let's take a look at some great client examples that could really pique your interest. Okay, I picked up a new tax client. I looked at their tax return and I said, oh my gosh, you guys, do you realize you just left money on the table by not doing proper tax planning? What happened is they were early retirees at 62 and 61, preparing their own tax return. In the year of retirement, they were scared about doing any type of tax planning or taking any money out of their 401ks. What was the result? They had about $13,000 of income, but remember the standard deduction was $25,000. They could have taken in from their IRA about $13,000 out of their IRA tax-free, and that was lost. So make sure when you're in retirement, early retirement or whatever, that your financial planner and your CPA are working together to make sure that you don't leave money on the table. Okay, second example, I have some professionals retiring from their company. In the year of retirement, they have great numbers. Only thing is, you look at their large IRA. But let's talk about the rule of 72s, just for an example. If you have an IRA today, let's just say it's $2 million, and you're 62. The rule of 72 says if you take 72 and you divide it by the rate of earnings on your investments, that's when it will double. So let's say this $2 million, just for an example, is earning 7%. In 10.3 years, that $2 million is going to be $4 million. So this 62-year-old is now 72 years old, and now after 10 years they have $4 million. Well, what does that mean? That actually means that the required minimum distribution that couple has to take out of their IRA is $150,000. Now, mind you, they're 72, so that's $150,000 of taxable income. Now you've got Social Security, could be $30,000. So, and so on and so forth. So what that couple needs to do at age 62 is plan on pulling some of that income in the years between 62 and 72. And that's what tax planning does for you. It saves you money so your retirement can last longer. I hope this is helpful. I know it's exciting to me, and I love this type of work. You can tell it's my passion. So I hope that you're talking to your CPA and your financial planning about this, what we call the tax drag on your retirement. And please reach out to me. You can reach me. I'll put a card at the end, and you can reach me in all different ways. All right, until next time.